pretty bad. It's pretty bad. Just a reminder here, the so-called circuit breakers on the major averages are activated when they fall at least 10%. Then you see a pause in trading.
These are big double-digit declines.
The implied volatility surged to its highest since February. I mean, as you see it just kind of jigging and jagging and jigging and jagging, going, and it's basically...
And when you look at the stock markets right now, you're saying, okay, the world's kind of burning right now, too. It's not pretty. It's not pretty at all.
You know what? The Fed still matters.
In labor market terms, the Fed thinks we're basically where we need to be to start the exit process.
You also ask, what mistake can I afford to make? And they cannot afford to make the mistake of completely destabilizing the global financial system. So I don't think the Fed will take the risk of hiking, and they cannot afford to make the mistake of completely destabilizing the global financial system. There are no circuit breakers.
Does this spell doom and gloom?
That would suck.
Stay cool. This is a Thor News presentation. Hit the button, baby. Thor News presents. Seriously, bro.
September has begun. The stock markets shall continue to be the opposite of fun. Currencies are crazy business, and the stock markets are one hell of a beast. We're seeing credit spreads widen, loans tighten, oil weeble wobble, gold go kerplunk, even copper and corn in a funk. Why, you may ask? Well, these are the national bonds that bind us. There's a whole lot of debt at this profit party. I just hope the tab ain't walking the plank, Frank. Currency wars. Global currencies are a hell of a thing, man. Money is for crazy people. But crazy Shemitah. A jubilee. A jubilee is a forgiveness of debts in a world awash in central bank liquidity. Will she crash up or break down? We're doing the wonky, funky, honky-tonk here as we cover the last week in world economics. Economics is where all the action is. Cloak and dagger, smoke and mirrors. We've got volatility. We have volatility. We've got volatility up, wonky, wackiness, and possible financial fuckery going on right now in this currency swap. Debt credit money, limit down days. We had the Standard & Poor, the Dow Jones, and the NASDAQ open limit down, which means they opened the maximum amount of down you can possibly open under their rules. 10%, I do believe. We saw a 1,000-point loss in the Dow Jones, which bounced back to almost no loss at all in a New York minute.
When's the last time we've seen a drop of nearly 1,000 points?
I mean, think about this, right? There are two really weird things going on the last few weeks.
It's not pretty. It's not pretty at all.
What it's telling you is the market, already besieged by basically, China slowing down on one side, simply cannot have the Fed be hiking rates at the same time.
We have the white line, which is the 30-year Treasury yield, and the yellow line is the S&P, and I've created this red shaded box around the area. You expect that as stocks plunge that you're going to see yields fall. Instead, as you can see on the white line in this boxed area, yields rose on long treasuries even while stocks were falling is a very unusual thing. So quantitative tightening.
I think China did what it did 2 weeks ago by letting the currency go to prepare to pave the ground for a Chinese-style QE. They have to prepare to let the currency go.
And so if they do a free float of, they let the currency go, what are the aftershocks of that for the global economy?
I think that's going to be a big shock.
It's more than that. And the NASDAQ, you'll see right here, is down 4%, kind of in line with the other benchmarks. It had earlier been down more than 8%, so a great deal of volatility.
From where you sit, was there a catalyst for the S&P losing steam?
I didn't see anything.
Someone described it earlier today as not an event-driven sell-off, as we saw with Lehman, but a fear-driven sell-off. So what do you do here? Yeah. Do you jack up interest rates and risk your economy, or risk your currency getting very volatile?
It's just a pretty ugly mess there. Just a bad scene.
Yeah. Are we seeing this slower growth across Asia and other emerging markets?
Absolutely. I mean, the emerging markets was already slowing in their growth. This just adds insult to injury. It's just proving that it's going to slow even more. It's just bad news.
And the numbers aren't real.
I don't think that even tells the story just how bad is it.
It's pretty bad. It's pretty bad. Just a reminder here, the so-called circuit breakers on the major averages are activated when they fall at least 10%. Then you see a pause in trading.
These are big double-digit declines.
The implied volatility surged to its highest since February. I mean, as you see it just kind of jigging and jagging and jigging and jagging, going, and it's basically...
And when you look at the stock markets right now, you're saying, okay, the world's kind of burning right now, too. It's not pretty. It's not pretty at all.
You know what? The Fed still matters.
In labor market terms, the Fed thinks we're basically where we need to be to start the exit process.
You also ask